By the end of this brief, you'll understand how the Nikkei's record-breaking surge has reshaped the landscape for Japanese equities, with analysts now eyeing a bold target of 70,000. This week, the Nikkei 225 achieved a historic milestone, soaring past the 62,000 mark with an incredible 3,320-point daily gain. Reports from Nikkei CNBC attribute this leap to a perfect storm of rising AI semiconductor demand and a significant easing of geopolitical tensions in the Middle East, sparking a massive short squeeze across the index. Veteran economist Asakura Keisuke described this price action as a blue sky breakout, highlighting that the index has entered a territory devoid of historical overhead resistance. He noted Kioxia Holdings' daily limit up as a pivotal sign of the aggressive return to the Japanese tech sector. Domestic sentiment is overwhelmingly bullish post-breakout. Prominent analyst Nobuhiro Tamatsu, also known as Nobujuku, has flagged 64,698 as the next immediate technical hurdle, with long-term models suggesting a trajectory towards 70,000, assuming the current macro tailwinds hold. For international macro desks, the key question now is whether the index can establish a solid base above 60,000 or if this vertical surge will necessitate a liquidity-seeking retest. Keep an eye on 64,698 as the primary resistance level, and watch Kioxia's performance as a bellwether for the broader tech trade. The fight for the 160.00 level in US dollar to Japanese yen has escalated from mere talk to serious capital flows. Following a brief breach of this psychological barrier, the Ministry of Finance is suspected of injecting approximately 5.4 trillion yen into the market to penalize short yen positions. This intervention was far from standard, it was a calculated strike. Rakuten Securities views the 160.00 mark as a tactical counterpunch ceiling. By targeting the market during thin liquidity periods, the ministry aims to maximize pain for speculators, instilling a lasting fear of the invisible hand at these heights. Yenzo Market, a former interbank trader and FX strategist, pointed out what he refers to as stealth intervention appearing as low as 157.30. The immediate trading range has now been forced down to between 155.50 and 157.30, marking a short-term victory for the authorities. But this defense goes beyond just round numbers. Technical analyst Shursen FX and Equity Forecast suggests that the ministry exploited low liquidity holiday hours to bolster the yen's recovery. He identifies the 158.00 level as a new critical line of defense that traders should monitor closely. For global macro desks, the focus has shifted. We're now observing a zone of intervention risk rather than a single price point. Watch the 158.00 handle. A sustained break here could test the ministry's resolve and potentially trigger another multi-trillion yen intervention ahead of the next Bank of Japan policy meeting. The recent momentum in the Nikkei 225 has been largely driven by a select few high-conviction AI stocks. Notably, SoftBank Group and Advantest have played a significant role, contributing a whopping 1,263 points to the index's gains in just one trading session. This surge was fueled by a broader risk-on sentiment from the US, especially following strong earnings from AMD and a notable rally in the Nasdaq. SoftBank's shares soared 18%, reflecting a substantial re-rating of its portfolio as a global AI powerhouse, primarily driven by the soaring valuation of its stake in ARM. Meanwhile, Advantest remains the main Japanese proxy for NVIDIA-linked demand in the semiconductor testing arena. On the fundamental side, Japanese equity analyst Gakko Channel, who monitors the US and Japanese tech sectors, emphasized that this rally is rooted in EPS power, not mere speculation. He pointed out a 27.1% profit growth rate among sector leaders, indicating that the Nikkei's rise is increasingly detached from domestic economic data and more aligned with the global semiconductor capital expenditure cycle. For those trading in Tokyo, while concentration risk in these names is high, the earnings momentum is currently the primary tailwind. Moving forward, keep a close watch on the 40,000 psychological level for the Nikkei 225. The next major test for this rally will be the forthcoming earnings report from Tokyo Electron. Watch for any discrepancies between these tech heavyweights and the broader topics as a signal of potential momentum exhaustion. A fundamental shift is underway at the Ministry of Finance and the Bank of Japan regarding their approach to defending the yen. The previous strategy of direct currency interventions, selling U.S. treasuries to buy yen, has reached its political and practical limits. Analyst Nobujuku suggests that Japan is facing mounting diplomatic pressure from Washington concerning its vast U.S. debt holdings. Offloading treasuries to support the yen could destabilize the U.S. bond market, compelling Japan to pivot towards domestic interest rate hikes as the primary tool for currency stability. This transition is crucial because the structural factors contributing to yen weakness show no signs of abating. Rakuten Securities notes that high WTI oil prices are perpetuating a trade deficit, and as an energy-importing nation, Japan faces consistent yen selling pressure from expensive oil. This structural challenge means that the ministry's occasional interventions offer only temporary relief while the underlying trade balance continues to exert pressure on the 155 to 160 range. Consequently, market focus has shifted entirely to interest rate differentials. Ponchio, a Japanese investment strategist, warns that intervention is futile as long as the yield gap between the US and Japan remains significant. He posits that a decisive move from the Bank of Japan, the BOJ, could change the trend, potentially bringing US dollar to Japanese yen back toward the 140 level if rates rise consistently. For global traders, the divergence is stark. While foreign sell-side analysts expect the BOJ to remain cautious to avoid stalling economic growth, domestic analysts view yen depreciation as a critical threat to consumption. The contrarian perspective suggests that the BOJ is now being weaponized for currency defense, stepping beyond its traditional inflation mandate to stabilize the exchange rate. Positioning remains heavily tilted toward yen shorts, leaving the market susceptible to a hawkish surprise. Keep an eye on the 10-year Japanese government bond yield. A break in hold above 1.1% would indicate that the market is anticipating a BOJ pivot. The July policy meeting will be a pivotal moment to watch, as a simultaneous reduction in bond purchases and a rate hike would signify the end of the intervention era and the dawn of a policy-driven yen recovery. This macro analysis explores the structural rotation occurring within the AI trade, as institutional capital shifts from the brains of the system, the GPUs, into the nervous system and lungs, the CPUs, power grids, and cooling systems. The magnitude of this transition is underscored by a recent 50.9 billion yen investment from DataSection, a prominent Japanese AI and big data firm. Their substantial commitment to NVIDIA B300 architecture highlights that while the capital expenditure cycle is far from over, the primary bottlenecks are evolving. On the Japanese equity side, analyst Gakko Channel points to what he refers to as a CPU renaissance. The narrative is straightforward. As AI transitions from mass training to deploying complex AI agents, the workload demands sophisticated sequential processing that GPUs alone cannot handle efficiently. This evolution is generating a secondary wave of demand for high-end CPUs and system-on-chip architectures, where Japanese suppliers hold a crucial advantage in the global supply chain. However, macro concerns for traders extend beyond just the chips. They encompass the physical power needed to operate them. Analyst Tyler Wilson has highlighted the skyrocketing moves in power and cooling stocks such as Vertiv and Eaton. He cautions that while the infrastructure story is strong, the current valuations of these picks and shovels stocks may be approaching overheating. For the Tokyo market, this implies a renewed focus on utilities and heavy electrical machinery. The Ministry of Economy, Trade and Industry, or METI, is framing this as a matter of national security, offering substantial subsidies to position Japan as a regional hub for data centers. This shift is significant for trading strategies, redirecting focus from high-beta semiconductor equipment to more industrial components of the Nikkei 225. While the foreign sell side remains fixated on NVIDIA's next earnings report, domestic Japanese analysts are increasingly scrutinizing the divergence between chip makers and power infrastructure providers. If you're positioned for a continuation of the AI trade, the risks now extend beyond just a slowdown in chip demand to include physical constraints in power delivery. Keep an eye on upcoming earnings from Japan's major utility providers and heavy electrical manufacturers. These will be critical indicators of whether this infrastructure rotation has more room to grow or if the overheating warned of by Wilson is about to trigger a broader market correction. Geopolitical tensions in the Strait of Hormuz are critically important for the Japanese yen due to the country's heavy reliance on energy imports, which are the largest structural contributor to Japan's trade deficit. With Brent crude recently approaching the $90 mark, the pressure on the JPY is intensifying, as Japan depends on the Middle East for over 90% of its crude oil supplies. Al Jazeera English reports that the IMF warns of a potential surge to $125 per barrel if regional conflicts escalate. For Japan's economy, this poses a substantial growth tax. In response, Japan Today reports that the Ministry of Economy, Trade and Industry is strengthening ties with the United Arab Emirates to enhance joint crude oil stockpiling initiatives, effectively establishing a strategic buffer against supply disruptions. Macroeconomic analyst Joe Bloggs cautions that we are witnessing a decoupling, where equity markets seem oblivious to the real economic pressures at play. While major Nikkei companies may gain from a weaker yen, the escalating costs of imported inflation are diminishing domestic purchasing power. This trend reinforces the sell yen on oil spike strategy for macro traders. Should naval escorts under Project Freedom fail to reduce insurance premiums for tankers, the trade deficit will likely worsen despite export volumes. Keep a vigilant eye on the $95 Brent threshold. If breached, it could prompt fresh interventions from the Ministry of Finance to stabilize the currency. The upcoming customs-cleared trade balance data release on Wednesday will be a crucial data point for this trade. The introduction of China's new supply chain law poses significant implications for Japanese industrial equities and the Nikkei 225, creating a potential exit trap for companies heavily invested in mainland China. Analyzing this law, DW News highlights its aim to penalize firms attempting to shift production lines out of China, directly targeting the China Plus One strategy. For Japanese giants like FANUC and Toyota, the costs associated with de-risking have now transformed into potential legal liabilities. The geopolitical friction also extends into the high-tech sector, as Bloomberg Markets reports China's intensified state control over AI technology, including the recent blocking of Meta's acquisition of a Chinese startup. This signals that Japanese semiconductor equipment manufacturers and AI-related firms may face increasing challenges in repatriating or selling their Chinese research centers and assets. However, Tokyo is not following Western sanctions in lockstep. Japan Today reports that a Japanese business delegation is planning a visit to Russia, highlighting a multipolar trade approach where private sectors aim to maintain global operations despite rising political pressures. For macro traders, this shifts the conversation from revenue risk to asset risk. The 40,000 level on the Nikkei stands as a psychological pivot point, but the critical data to watch is the Ministry of Economy, Trade and Industry's upcoming report on supply chain resilience. If the ministry signals a formal subsidy initiative to counter Beijing's exit penalties, it could catalyze a rotation away from China-exposed industrials toward domestically focused infrastructure plays. Stay alert for any retaliatory actions from Beijing as the G7 tightens export controls in the coming month.